When you think about retirement, there are a variety of things that are top of mind, that come to mind, and that you should be thinking about. And one of the most important questions that you should ask yourself is, how big should my portfolio be before I retire? How much income do I need per month, per year in retirement? And today we're going to dive into an example case study to show you that that number is completely unique to you. Your neighbor might be telling you you need $1 million. You might hear talking heads say $1 million isn't near enough to retire. And while that might be true for them, you are unique and your individual circumstances might call for a different number. So let's dive into this example case study. Here we have Jeff and Jen. Jeff is 57 and Jen is 58. Today they are still working. Jeff's salary is $80,000 per year and Jen has a salary of $70,000 per year. They're going to have their Social Security benefit in retirement, and we're just going to use the simple estimate. The way that the simple estimate works is the program's going to use their current salary plus salary increases to estimate their future Social Security benefit. For salary increases, we're assuming 3% per year. And again, this is for both Jeff and Jen. Going into their savings, they are actively saving. They have a 401k, each of them. Jeff puts away 3%, Jen puts away 5%. Jeff is matched at 3%, Jen is matched at 5%. Pre-retirement, they have living expenses in the amount of $7,000 per month. And if we go into their net worth, we can see here that they have a total net worth of $1 million. But the thing that we're focused on is they have an investment portfolio. Their total balance here is $550,000. It's important to note that all of this money is in qualified accounts. Jeff's 401k balance is $300,000 and Jen's is $250,000. So what does a qualified account mean here? Well, all of this money went into this account pre-tax. It's growing tax deferred, and when they go to take money out of this account, it's going to be taxed as ordinary income. They also have a property worth $400,000 here, and they have no mortgage on this property. Going into their goals, Jeff would like to retire at 65 and Jen would like to retire at 66. And in retirement, if possible, they'd like to spend $6,250 per month. They also have a joint vacation goal. And Jeff and Jen would like to spend $7,500 every year starting at retirement, and they would like that to last for about 15 years. And we're going to assume that this gets adjusted for inflation every year. In retirement, we're just going to use the annual retirement health cost estimate of $6,400 for both Jeff and Jen, as well as the annual retirement long-term care costs in the amount of $75,500 for both Jeff and Jen. It is important to note that these numbers, their annual retirement health costs as well as the annual retirement long-term care costs, are as of today. So these are going to be adjusted for inflation until they retire and until they actually receive that long-term care. Going into the retirement analysis, we can see that given the inputs today, they have an 87% probability of success. And if we look at the ending assets of their current plan here, we can see that at 90 at the end of the plan, they'll have about $9.7 million in assets. So clearly for them, assuming their current allocation and assuming they retire at 65 and 66 and spend $6,250 per month in retirement, they're in a pretty good spot. If we go into their withdrawal rate, we can see here really quick that throughout retirement, they have a sub 6% withdrawal rate, and this looks pretty good. The reason why the withdrawal rate's a little bit higher early on in retirement is because they are retiring before they collect their Social Security benefit. So now obviously there are a couple things that we should look at here. Today, pre-retirement, Jeff and Jen have an allocation that's assuming 100% stock exposure. Well, obviously, when they go into retirement and they start relying on their portfolio for income in retirement, they're going to need to adjust their portfolio. So we're going to assume that in retirement, they have a balanced portfolio allocation. And for the sake of this example, we are assuming that a balanced portfolio is a 50-50 portfolio. 50% stocks, 50% bonds, with a hypothetical annual return of 7.4% and a standard deviation of 8.6%. Well, we can see here that this brings their probability of success down to a 69% probability of success. And looking at their ending assets, we can see here that they have about $1.4 million at the end of their plan. And again, this is assuming that they spend $6,250 per month in retirement. Well, diving into their withdrawal rate, we can see here that they have a pretty solid withdrawal rate. We can see that for the lion's share of retirement, they actually have a sub 5.5% withdrawal rate. That means that they're relying on their portfolio in the amount of about 5.5% per year to fund that $6,250 monthly expense. There's a couple things that we should look at here. Today, we are assuming that they collect Social Security at the age of 67. Well, what does it look like if instead of at the age of 67, they collect at their retirement date? Going in here, we'll adjust this to their retirement. We'll hit refresh. Well, if they collect at their retirement date, we can actually see here that this doesn't do much to their plan. So let's dive into the Social Security widget here. And let's go into the summary and let's see when it makes most sense for them to collect their Social Security benefit. Well, from a sheer benefit perspective, we can see that obviously if they delay until the age of 70, they're going to get the most amount of income from their benefit. Well, if we go back to the analysis, if it didn't really do much to their plan to collect at 67 or at their retirement age, let's move this back to full retirement age. We'll refresh this and we can see that, yes, we have that 69% probability of success. And then at the end of the plan, we can see here that we have $1.3 million in median ending assets. So for Jeff and Jen, how much can they spend in retirement on a $550,000 portfolio? We can see here that if they spend $6,250 plus that $7,500 vacation goal, they're in an okay spot. We can see that they have $1.3 million at the end of their plan. Their withdrawal rate isn't crazy high up until the end of retirement. And the reason why it's so high at the end of retirement is because they have that long-term care goal. That long-term care goal was $75,000+ today adjusted for inflation. And so if we jump into the cash flows, we can see here that obviously from today up until retirement, they have spend from unsafe cash flows. They actually have additional savings in the amount of $20,000. For the sake of this plan, we just assume that they spend that money. And then at retirement, we can see here that they have a negative net flow in the amount of $130,000. That lasts for 2 years until they collect their Social Security benefit. And then at 75, when they start pulling those RMDs, we can see here that, again, they have spend from unsaved cash flows. So for Jeff and Jen, spending $6,250 every month in retirement, it looks like this is something that they could potentially do. So if we increase their monthly retirement expenses to $7,000 from $6,250, we can see here at the end of the plan, they have about $870,000. Obviously, that's substantially less than if they were to only spend $6,250, but we can see here that for them, they still have quite a bit in ending assets. Going into the retirement details, we can see here that they have a withdrawal rate for the lion's share of retirement. That's a sub, 5.5% withdrawal rate. So overall, this actually looks like something that they could potentially do. Now, one thing I do want you to keep in mind relative to increasing their monthly expenses, this really depends on how you are allocated. Are you willing to take on more risk? Does 100% equity allocation for you make sense all the way up until retirement? Or are you adjusting your portfolio today to prepare for retirement? Just to give you an example of what this looks like, let's assume that they don't have 100% allocation today. Let's assume that they have a growth allocation, which is a 70-30 portfolio. Let's see what this does to their overall plan. Well, as we can see here, if they had a 70-30 portfolio from today up until retirement, and then at retirement had that balanced portfolio, we can actually see here at the age of 89, they run out of money. So for them, spending $7,000 per month in retirement wouldn't make sense. Spending $6,250 in retirement, assuming that growth, pre-retirement growth allocation and balanced retirement allocation would barely make sense. They'll have $268,000 at the end of the plan. So when you think about retirement, you think about the monthly income that you will need, and you think about your portfolio balance. It's important to put your situation into a plan like this so that you can go through, what does it look like if we increase our expenses? What does it look like if we retire early or at a later date? What does it look like if we change our allocation pre-retirement? How does that impact our plan? What does it look like if we change our allocation in retirement? How does that impact our plan? Guys, there is a variety of things that you need to be mindful of when it comes to your retirement. We talk about this a lot on the channel, but in particular, there are 6 things that you should be mindful of. What are your retirement goals? Where is your income coming from, and do you have an income gap? What are your expenses in retirement? How much does your desired retirement lifestyle cost? What is your withdrawal strategy? What is your investment strategy? And finally, do you have a tax plan for your retirement? These are things that you should be thinking about, that should be top of mind when you're evaluating how much can you spend in retirement and what portfolio balance do you need to support that monthly expense. If you would like to create your free DIY retirement plan, click the link in the description and we'll see you there. Thank you so much. And until next time, bye-bye.